What's up, everyone? Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today we're going to talk about home sales like soaring despite the rate fluctuations that are going on with the Fed dropping rate, but mortgage rates going all over the map. And then the market's projecting more rate cuts. But is that going to help mortgage rates? I don't know. I'm not entirely sold on that. Anyways, let's start with new home sales, guys. Surged in August. So this is one of those stats that we get in arrears. Like we get finally after a month's worth of time, all the data is done. They close the book. So in the month of August, compared with July, new sales of newly built homes rose at 20.5%. And here's the crazy part. That the median price of a new home was $413,500, which was an increase of 1.9%.
Yeah.
So not only was there a surge of supply being sold, but prices held and even upticked on average. This is not what you would normally consider hand in hand when it comes to statistics and math. You go, oh, wow, 20% increase in sales. There must have been a cheaper price tag. Well, not the case. So what do you guys make of this?
Well, that's actually good news. That's not a bad thing. And remember, when we hear that it's soaring, that's for newly home built. This is not for existing. So if we look at a whole pie chart, that's just a little piece of the pie chart right there. You know, we're really more focused on the existing homes is what sells the most. So just so we keep that clear, right? But it was good that we saw that this was the best in 3 years. And even 3 years ago, it wasn't like we hit that 20% like we did in this time around, which is good.
Yeah, for me, it's starting to look like people are just finally not worrying too much about the price, but more about the monthly payment. So when rates drop, some people are like, hey, I can afford this monthly payment. Let me jump in. The price of the house is what it is, but I can afford the payment. So therefore, I'm going to go ahead and purchase a property.
Now, given the fact that rates went down before the Fed ended up reducing the rate publicly at their meeting in September, what did you guys think like September's reading's going to come in at? Like 20.5% in August is a really big number. I would expect that that's going to kind of tip over into September as well, because there's probably contracts that were opened in August that closed in September. And I'm saying this because I'm setting up a precedent is the first and second week of September, mortgage rates were lower than they were in August.
Yes.
So I'm expecting that we're going to see a repeat of this by the time we get into the end of October and we get September's number. We're going to look at something probably very similar.
I agree. I really feel like the new builders are actually getting very aggressive with offering incentives, you know, like a 3-1 buy down, for instance. We have one here in Chula Vista they bought, and the rate was at 3.99.
Yep, I've seen that.
And they actually gave them on a 5-year, it wasn't a 5-year option, on a 5-year ARM. So it is an adjustable rate mortgage, but it's a 5-year fix. And then after the 5th year is when it actually adjusts. So that gives them plenty of time to fill out the market, which is not a bad thing. So either they were able to get this rate, you know, which it was a pretty much buying down the interest rate to a 3.99, or solar. So you got to get one or the other. So they decided to forfeit with the solar and just purchase the solar and, go with the 3.99 interest rate, which is not a bad deal. So when we're seeing the builders get creative in this manner, it really helps keeping the sales comparables in the area to what they're selling at, which is good. And again, builders see homes as a commodity. That's how they're seeing this thing. It's like, how many of these properties am I going to sell? Because remember, they have a commitment, a forward commitment also to their investors. So they got to keep up with times of, the approach of how do we make it where the consumer is going to want to come and buy our home.
Yeah.
So I think it's good. It's a good aggressive approach for them to do this.
Well, I'm going to make the argument that that sentiment is back. I know I said it a couple of shows ago, and we did a great series this summer, the no FUD stuff. No fear, uncertainty, and doubt. So a lot of great case studies. If you missed any of those shows, go back and watch those, talking about actual deals in the market that Memo and Brian are both working on. But we had also had a show where I remember saying sentiment is back because you see a ton of flood of inventory coming to the listing side, which then becomes existing home sales. Pending sales are up. Closed existing sales are up year over year comparatively. Now, this one is more of an outlier because it's new home sales, because they're doing incentives like that. But I think the backstop of this whole thing is that buyers are back. I think people that are sick and tired of waiting, or they're waiting for some sort of confluence of factors like more inventory so they have greater selection at the same time that borrowing money was cheaper. I think this is the window. I think the fourth quarter is probably going to have really good housing stats. Like looking forward, I know I'm crystal ball guessing here. I honestly think think fourth quarter is going to be the strongest of 2025.
Yeah, and I think it starts right now in the fall because, I've seen people start the transaction and take about 3 months for them to actually, 3-4 months to actually find the property that they're looking for. But what that does give you is time in the market, which you're able to see how the market's performing. You see how rates go up, you see how rates go down. And I think the more time you spend in the market, you'll understand how you need to submit offers, what, advantages you have by being able to just have a better understanding of how houses are, selling, how agents are trying to, get rid of those properties. And I think just keeping a track on that will help you be a little bit more strategic when locking in your rate.
What's something you're talking to agents about right now, Brian, with clients that are out there looking that maybe have been, approved or, they're kind of maybe tepid. They're not super hot, but they're like trying to sniff around the market. What kind of conversations are you having about that?
So we have a current client which has been looking for multiple houses. And what happens with them was that price point. They started at a $650 price point, but then they weren't able to find something that fit their needs. They wanted 3 bedrooms, 2 baths in La Mesa area. And we had to have the conversation with the agent and the clients, letting them know like, hey, the houses you guys want and everything you guys let us know that you guys need is in this price range, which you guys are approved for. And you can, you're able to make offers on that. But now, is it the payment or is it the price point of the property that's basically the obstacle? It's the payment all the time. So when we do is we try to find strategies where we can negotiate either seller credits to bring the rate down, permanent rate buy downs, or, just being smart with the way that we structured the deal to try to help them save as much money as possible in the first couple of years if they can. But it comes down to the motivation of how much they want the house. And if they want the house enough, the payment will adjust and they'll be okay with it. They'll make the sacrifices needed. But I think it's really finding the motivation of what they need and not what they want, and just letting them know like, okay, we have to cut, the FUD out. We can't be, we can't be wanting to have everything. We have to be strategic. You have to have what you want and then go attack that.
It's just casual observation from my side of like the office wing is I see you talking to a lot more agents or having a lot more conversations with your agents now and with a lot more buyers than even just a couple months ago.
Yeah.
No, it's definitely important to bring everybody in, especially agents. A lot of times it's just saying, hey, let's just put the offer, let's see how it goes. But as a lender, we got to get creative. We have to help them understand what are the client is looking for. And every client's very different. Each one's going to require a little more of some than the other. And right now, what we're seeing a lot of is they want to leverage, seller concessions. The bad thing about it is like here, it's a new home builders, and we're talking about a lot of this soaring of this 20.5% has been Northeast. In those areas. So when you come to San Diego, it's very different. Every market is very different. And those are the things that we have to share with our audiences. Every area is different. So here, for some reasons, I'm going to go back with the concessions because it was like, that was something that was happening quite often. And then all of a sudden, the last month and a half, almost 2 months, is like, there's no seller concessions and there's multiple counteroffers, which is crazy. And this was prior to the announcement that the Fed's going to reduce the Fed funds rate. Now, I imagine what's going to happen now, announcing that there's going to be 2 other adjustments. That's going to bring even more sideline buyers into this equation. So I got to agree with you 100%. If this is already what's happening, and we've seen this, we haven't seen rate cut in, it's been a year. And then prior to that, it was like 3 years. So it's like, it's time. And so these new adjustments with these rates are going to really start bringing, sideline buyers into the market.
Yeah.
And I think that's what's going to help fuel even more of our current housing market, because we're in a housing recession right now. And we've been there for a few years already. And being that, affordability as at its all-time low, it's like, how do we get these sideline buyers into the market? Because I know they want to be there.
Yeah.
But we just got to help them get there.
Yeah. And I think the builder incentives is a big part of it. And then that leaves the question, what about existing sales? Like that puts the pressure on the current owners that are like, well, I got to compete next, if they're next to a development, I got to compete next to them. It's getting $50,000 of solar credit or a $50,000 equivalent buy down for 5 years to a 3.99. Like that can put some market pressure kind of, I'll say regionally.
Yeah.
around certain parts, but those incentives are a big deal. There's like, I think the article was saying like 39% of developers are saying they're looking at incentives as part of moving inventory.
And that was prior to a 37% before.
Yeah. So there are, there's more of them.
So we're getting more to want to give that incentive because that's what keeps fueling the economy. And remember, builders look at homes as a commodity. Unlike the regular homeowner looks at it like, oh, there's a lot of sentimental value into this, right? And so I don't know that I want to give that, or I think I'm losing. It's like, no, you're not losing. You're still gaining. Thank goodness there's that equity. It's like sometimes we just got to help, pass it on to somebody else, pay it forward, right? And paying it forward is just, how do I help them help me? And then when I'm looking to buy my new house, it's like, I'm probably going to expect the same thing.
Yeah.
So it's going to allow everybody to learn how to negotiate and do the right thing.
Yeah, it's like car dealership wars,
Absolutely. Absolutely. And that's why it's good that Brian is sitting down with more of his realtor partners, helping them understand how to get creative, how to go out there and negotiate a 1-1 buy down, 2-1 or a 3-1 buy down, and kind of utilize his knowledge when we're competing with new builders, which is very difficult, by the way. Very difficult because their incentives are like $30,000, $40,000.
Yeah, we can't.
It's very difficult, So now if we just teach our agents to treat their business the same way, then it just makes them.
I was like, go ahead.
No, I was just going to say I think it's even more important right now. The agent and lender relationship is very tight because of the fact that you have to be a little bit more, I wouldn't say aggressive, but more upfront with buyers to let them know like, hey, you want this is how we need to do it in order to get what you want. Might not like how it sounds, but it's what you want. And if you don't like that, then we can, readjust what you wanted. But
Absolutely.
I think it's our job to get them what we want. And then from there, digress if that's not what they're looking for.
I'm going to tell you guys a story that I may have shared with you already. I'm not sure I'll share it with the audience ever, but it's an old marketing analogy, and it's a story about creativity in the market. And it's a mom and pop furniture store that got flanked on both sides of them with new large scale department store furniture stores.
Yeah, furniture stores.
On the left hand side, they're running a sale. It says 50% off all inventory. And on the right hand side, they say buy one, get one free. And so the mom and pop shop in the center put a big sign on their above their door that said main entrance. So
there you go.
Keep your creativity on the upswing, everybody.
Yeah, that's very creative.
Your competitors are going to do whatever they're going to do, and you get your chance to react. So
that's awesome. I like that. That's funny.
Yeah. So yeah, you might be in a neighborhood where there's developers down the street and they're competing for the same buyers that you are as well. You might just have to get creative in what you're doing. So.
Yeah, no, it's actually really good point.
Yeah. So let's move forward real quick, guys, because I want to talk about this whole Fed thing. Like, there's a lot of back and forth about will they, won't they, what are they going to do? The pace of cuts should be this, they should be that. There's a pretty big disagreement between multiple Fed members on how much the Fed should be cutting, how many times more they should be cutting. They have this dot plot chart, and I think I have it. I'll throw it up on the screen right here. So you'll see the dot plot chart here, and it says that over the course of the next 3 years, basically 26, 27, and 28, rates should pretty much be bunched up together around this plus or minus 3%, 3.5% maybe, but like moving our way down into that very slowly. So that is not necessarily the pace that we had heard about after the pandemic first occurred. The idea was that by 2025, we'd be where this dot plot is saying we would be by like 2027. So we're effectively like 2 years behind based on the old dot plot chart. The old dot plot chart said that what we see right here in 2027 is where they were projecting at that time we would be up by 2025. So obviously that reveals to me they had some problems, and taking politics out of all this. I think this really just comes down to borrowing costs. We have a massive problem with debt, and at some point, you got to pay the piper. And this is going to determine how we're able to refinance a lot of our debt, how we refinance our debt, and I think, honestly, people's confidence in our bond system that we can and we will.
Yeah.
I think that's the way this is going to be played out.
Oh, yeah. No, absolutely. I do like the dot plot thing. Honestly, I never understood it until just recently. I decided like, hey, let's go in there and kind of see all this. I love it how it is actually 19 members, and they just pretty much just put in a dot where they think what the interest rates are going to be next year, the following year, and so on and so forth. So essentially, it's like a vision board in interest rates.
It's like an educated guess.
Yeah. which is pretty cool, But the great thing about that is that, the financial market, it just seems to move faster. It just understands the data. It consumes the data much sooner than the Fed does, you know? And so to put in perspective, it just puts it where, you got the Fed, they're a ship. They're just always just constantly kind of trying to navigate through the waters and seeing like what's going to be the best and easiest approach so that we don't just, tilt over. Whereas the market is just saying, hey, we can already see in the distance that the waves aren't going to be bad. We're just going to zoom through this really quickly and get through this and understand what the market's going to do.
Yeah.
Like, I can already see it. I might as well just go.
Here's what's so crazy though to me is because, I'd spent a lot of time covering this over the last couple of years. I know we backed off of this topic for most of 2025, but when you look at them and what they have been saying for so long was we have to get inflation down to 2% and we got to get employment under control, price control. We have to get price control and we have to have unemployment stable. Well, it's been consistent for a consistent enough amount of time that they had told us they would be making choices to make rate cuts and then they didn't. And now they're making rate cuts and they're saying, oh, we'll probably make some more, but they're like really, really slow walking it. And even their projection tables still don't get us down to inflation at 2%. Now, the argument is, of course, well, if you reduce rates and inflation is going to go up. But we've been holding them for longer than they said, and they still didn't go to 2%. So if the localized high was 4.25 to 4.5 for as long as it was, and it didn't bring us to 2%, then we're not going to get to 2%. You need to abandon ship on that idea and that concept because we're not going to get to 2% inflation if they're also saying they're going to progressively and slow walk the future rate cuts. That's just not going to happen. So it needs to be reset. And someone suggested this like a year and a half ago. Like, hey, do you think that you should reset to Jerome Powell? So you think you should reset it to maybe 2.5 or 3? He's like, nope, 2% is going to be our target mark. It's like,
we've been at 2% forever.
Well, yeah, but it's not going to get there. I mean, even the projection in 2027, based off current tendency and considering the future rate cut, still doesn't get us there.
Yeah.
So they're like admitting in the numbers. They're not saying it from they're not shouting from the mountaintops, the hilltops, but in the numbers is admitting, hey, it's not going to work.
It's not going to happen.
Hey, it's not going to work, guys.
Yeah. I mean, and that's what the market's telling you. The data is already in there. It already knows. It already understands all this.
Now, the argument on the other side is that, well, GDP is strong. Like GDP came in stronger last week's reading, right? Because it was supposed to come at like 3% and then 3.3 and it came in at 3.8. Okay, well, then that you could make an argument, well, then we don't need to reduce rates. Yeah. Everything looks like it's coming along just fine. Why are we got to reduce rates? GDP is fine, right? But I think that there's some other problems. I think it's going to come down to refinancing our debt. I think it's going to come down to borrowing costs on the corporate side. That's really going to have to drive down the Fed funds rate. Because that overnight borrowing rate is critical to so many different parts of our economy, like it or hate it. But it's never going to go to zero again. I can't imagine it going to zero like it was during COVID and after the financial collapse of 2008. So I don't think that's coming back. I think we have to be really measured and realistic in what the next 2 and 3 years looks like. So getting to 26, 2027, 2028. I think if we can land around that 3.5, I think we're going to be fine. But then if we can hold there and let some things equalize, like something has to be constant for long enough for us actually to look at it and go, okay, this pillar is in place. Let's put another leg of the table in place and another leg of the table in place. Yeah. Theoretically, I know it's easy to say this because there's so many millions of factors in this. But if we can just get the Fed funds rate to a place where it can stay and hold for a while, I think that gives us a better shot at looking realistically at what needs to be addressed once it's actually immovable for a long period of time.
Gotcha.
Sorry for the nerd rant, but I've been thinking about this leading up to today for a while, as you can see.
I think for me, like, when people listen, about the Fed at home and they're saying, oh, the Fed dropped the rates, this and that. One of the things that I have to make clear is that, it's different from what you hear then than what happened in the markets. And what I mean by that is that, once you hear that the Fed's going to speak, you should probably have got pre-approved the weeks before that and be a little bit early to the party, because whenever they say rates are dropping, the market is already predicting what the rates are going to do or what the Fed's going to do. And even though the Fed doesn't control mortgage rates, and we said this plenty of times, their decision heavily influences the direction. So the sooner, the faster you're able to get pre-approved, you put yourself in a position that when rates do dip, you're able to lock in your rate at the lower rate rather than wait to hear, hey, rates drop, the Fed dropped the rates, you go in the market, get pre-approved, and wait, why is my rate higher than what I thought it should have been? Because you're playing in reverse. You have to be early to the party. The more that you're in the market, the better opportunities, the better options you're going to have, and the smarter you're going to be with the decisions you make and the options you have.
Can I put a term that everyone knows? Fashionably late is only a thing in the social party scene.
Oh, yeah.
Not in the refinance world. Fashionably late is actually out out of luck. Yeah. But it's and when you hear us talk about the cuts are already priced in, that's what that means when we say that to you guys, is they were already priced in before. They were already anticipating the Fed was going to cut the rate. So when they announced it, it was just confirming what the bias was for the 2 weeks leading up to it. So they were already priced in when we locked in 24 or 5, whatever many loans there was. It was a lot. More than 20 loans in that week. So, Memo, I don't know. What do you the final thoughts on this from you?
No, my final thoughts are just like Brian said. I mean, he hit the nail on the head. He perfectly just said, you have to, everything's just prior to. Yeah. It's just prior to. We were locking in transactions prior to, like 2 weeks prior to the Fed actually even speaking, because it's like we saw the market taking good. We might as well pay attention to the indicators. Not only that, there's a lot of people that we follow that are they have these bright and brilliant minds. So we just want to go in there and be a listener. We also get educated. It's not like we know everything. We really don't.
We don't.
But we want to entertain and know what people do know out there and really allow the experts to speak. And we're just going to follow suit. And luckily we did, because the day that it happened, when our Uncle Powell spoke, everything went to shambles. It was a repeat of last year.
There you go. I was just going to bring that up.
And I was going to say that works on both sides of the coin. So because there were times when we're like, hey, rates are going to go down tomorrow, let's float. And then we'll wait till the next day and rates were lower, and then you lock a loan. Yeah. And on the other side is like, hey, the price action is indicating that tomorrow rates are going to be higher. We need to lock today, and you have to lock today, and you wake up tomorrow and rates are higher. So it's not just us yelling into the abyss through our microphones about rates because we know it all. We listen to qualified people that are looking at the same things we're looking at and might have a different slant sometimes, but are giving guided advice on what to do based on certain situations. If you're buying, look at this. If you're refinancing, doing that. If it's government, look at this. If it's conventional, do that. If it's jumbo, do that. The markets all react differently. It's not always everyone goes the same direction at the same speed at the same time. Sometimes they move a little slower than others, depending on what you're doing.
Yeah.
And again, the consumer doesn't understand that it's not just always the rate. The rate's going to increase by a 0.25% or what have you. It's the cost for the rate that increases in the back end. Margins get compressed, and therefore now we put that on back to the consumer, and now they're going to pay to get that rate. Now they're paying more, where day prior to they didn't have to pay anything. Yeah. But good old Uncle Powell just spoke, and there he goes. Everything just gets more. And we got to remember, he's very conservative.
Yeah, no, I think he's been playing it safe for really a long time.
Yeah, that's a better word.
I mean, I've been pretty upfront for this entire time we've done this show. I've always been upfront.
I would hope so.
No, I've been upfront the entire time. Like I think they're late. They're late all the time. They're late when they got to drop rates. They're late when they got to increase them. I think they held for too long. They actually, basically, looking backwards now, you probably could have made an argument that they could have done another rate hike to take it past 4.5 for maybe a 6, 12, or 18 week period to see then what a 90-day collection of data looked like, and then start cutting down by quarter points. Look, everything's easy. 2020, hindsight's 2020. I get it. But in this case, I think that if you are looking at the fourth quarter for your life in real estate and mortgage, if you didn't refinance already in early September, like you got to be on the what do they call it when you go on a plane? What's it called? The boarding?
Turbulence.
No. When you're getting on the plane,
boarding.
What's it called? Yeah. What's the hallway you walk on? Not the turnstile. How come I'm blanking on camera right now? The gangplank.
Okay.
Gangplank? Is that what it's called? No, it's
the waiting area?
No, when you walk from the terminal to the airplane. What's the stupid hallway you walk through?
The connecting bridge.
Whatever. The bridge. Is that what it's called? Oh my gosh. Hey, roast us in the comments right now.
Please.
None of us who've flown a million times can remember the stupid name of the walkway from the terminal to the plane. Get there. Go stand in line.
Be ready.
Get yourself ready.
Buy your ticket
Get
first.
yourself ready.
Buy your ticket.
Get yourself ready, because I'm watching these guys already lock loans at rates that aren't, or having had already locked loans at rates now we don't have, or they're not the same cost to buy down. So you have to be ready right now. It's October, November, December. If rates take another dip, which they are going to, I'm just looking at the charts. They're going to take another dip sometime at the end of the fourth quarter. I need you to be there and ready and waiting.
Yeah. 100%. And the other thing is, remember, it's not just the Fed reducing reducing the Fed funds rate, there's going to be job growth. If the job growth is not there, that's going to have a huge impact on the interest rates. If inflation's not there, that's going to have another impact. Then we have the GDP, the gross domestic products, that like all these things will influence in the direction that we're going to head into, whether or not even the Fed's going to even consider reducing this. As we get closer to the federal, when the Fed meets, that's when we start seeing the data.
Yeah.
Is it investors 98% considering that the Fed is going to reduce the Fed funds rate or not? So all these things will factor in.
Yeah, 1 to 2 weeks is usually when we start seeing pricing being priced into the market. So take that.
It starts changing.
Yeah.
Well, next Fed meeting is at the end of October, everybody. So if you care about that, it's like already around the corner. 2 weeks have already passed since the last Fed meeting, and the next one's in 4 weeks. So that's coming around the corner. Brian, you were right. It's the bridge, the jetway. I'm over here looking it up real quick. Like, jetway. I'm like, I could say it wrong. Anyways, thank you guys for coming on today to talk about these two things. If you are in the market and you're looking at a new home build, tell us what kind of incentives you're seeing out there. Because, we see a lot of things here, San Diego, California, even some of the neighboring states. Every once in a while we're getting some in Florida, Virginia, Texas, Tennessee, Arizona, Nevada, to name just a couple. But if you're in another part of the country and you see some sort of like builder incentive in your neighborhood, like send it to us. I'm really curious to see what kind of buy downs, what kind of incentives and discounts are giving you, or home upgrades, or, a pool, so buying you a car, free car in the garage when you buy with them.
No DTI.
I'm just telling you, it's going to get super interesting here as inventory continues to increase. So any final thoughts, guys, before we sign off?
No.
All right.
I just want to say thank you to everybody that did take advantage prior to.
Yeah.
I'm glad that you guys put yourself in the best position possible, because that's what you have to do. You have to look out for your families and see what's the best position possible I can put myself right now to save money. And again, here's the difference with the people. If they understand how to leverage the situation of their savings and put it to work for them to create some type of wealth, that's a start right there. A 300, 400, 700. I mean, we had clients that sell it that are saving $900+
a month.
Yeah, a month. Yeah, absolutely. Of course, it's all loan amount, driven. But even if it's $300, if you just start putting that back to your principal, we can go with Dave Ramsey, how to pay off your property sooner. That'll take like 8 years, 9 years out of the life of your loan. And then if you decide to, hey, just let me put another payment extra a month at principal and interest, that'll take another 3 years off.
Yeah.
So this is the time to really sit down and like really put yourself in a position where, how do I invest into myself by taking advantage of these lower rates if I needed to? Obviously right now, that incentive, we had an incentive going. So it's very different than what most other lenders have out there.
Awesome. Yeah, good. All right. Well, thank you guys very much for another show. Thank you all for watching. Remember to like the channel, subscribe, turn on notifications so every time we drop a new video, you hear about it first. And also check out our playlist called Friends of Mortgage Heroes. Myself, Brian, and Will interview our friends in and around real estate. Actually got some cool guests coming up for quarter 4. Already got a couple people booked that I think you're going to be really interested in hearing from. And I'm excited to share all those episodes with you guys. So thanks for another great episode, you guys. Thank you all for watching, and we'll see you again next week.
See ya.
If you enjoyed this video and you want more of our content, subscribe here. And if you'd like to watch another video right now, click here.